Hello, everyone, and welcome to another great webinar from CPA Academy. Thank you for joining us today. My name is Gabe, and I'll be your moderator for today's webinar, the R&D Tax Credit, Taxpayer Savings, and the Big Beautiful Bill. Our presenters today are Mike Weber and Dawson Furco. Before we get started, I wanted to go through some housekeeping items and do some technical checks just to make sure everything is working. First, if you don't mind going to that Q&A tab on your control panel, and please let me know that you can hear my voice and see the title slide. Feel free to let us know one thing you'd like to learn from today's webinar. If anyone has any technical issues today, please let me know in that Q&A tab, and I will do my best to get around to everybody as quickly as possible. This is also where you can post your questions and comments for our presenters. And I see them coming in fast and furious from New York, from Tennessee, from Michigan. Thank you so much. So now that we know everything is working, let's go through some housekeeping. This webinar qualifies for 1 CPE credit or 1 CE credit. CPE credit will be available within 24 hours in your CPA Academy account. And for attendees with a P10 on file, we will upload your CE to the IRS at a later date. You'll earn that credit today by staying logged in for 50 minutes and answering the poll questions. We're going to have 6 polls today, and to earn credit, you'll need to answer at least 3 of them. I also wanted to let you know that we're recording today's webinar, and the archive, along with your credit, will be available in your CPA Academy account within 24 hours. And if you have to log out or log back in for any reason, the webinar software will keep track of your time. We also recommend you download today's presentation materials, which can be found in the control panel's handouts tab. So now that we're all set, let's welcome our presenters. Mike and Dawson, the floor is all yours.
All right, Gabe, thank you so much. And good afternoon to everyone. Glad you could be with us this afternoon to talk a little R&D tax credits and expense deduction finally after 6 or so years of kind of being in limbo with this thing. I'd like to take a minute and introduce us and our firm to you. You see my partner, Dawson Furco, here. We started Corporate Tax Advisors. We go by CTA for short. We started CTA back in 2014. We're founded based on the R&D credit. And heck, when we started this, the R&D credit wasn't even permanent at that point in time. It was something that expired every single year and had to be renewed by Congress each and every year. And that was back when we had a tax bill just about every year as well. So boy, has a lot changed in the last 10 or 12 years. We don't get tax bills that often anymore. And we now have this expensing coming back to our R&D expenses, which should enhance or at least enable you to maybe go back and consider the R&D credit as well, especially if you kind of, put a pause on it back in 2022 when this whole thing started. So that's what we do. We're a specialty tax firm. I'm a CPA by trade and decided to whittle down to 1 or 2 code sections instead of focusing on 9,000. So Dawson, do you want to introduce yourself real quick?
Yes, thank you, Mike. Good afternoon, everybody. Hope everybody's relaxed after the Independence Day holiday. I don't know if this will relax you, this conversation, but we're pretty excited about it. And so thank you for your valuable time that you're spending with us today. As Mike mentioned, my name is Dawson Furco. I'm one of the co-founding partners at CTA. I've been at this for quite a long time, and it does highlight on here on one of the slides that I'm what's called an IRS enrolled agent. Don't let that spook you. I am on the taxpayer advocacy side, and it's a nomenclature that lets people know that I can defend clients in front of the IRS in all 50 states. So I know a little bit about tax, probably not as much as many of the practitioners on the phone today. And the one thing I will add, because my portion of the presentation is towards the end, and I'll use a metaphor here. Mike's going to be kind of building the structure of the home, the computation calculation. We'll call it the framing of the house, the windows, the roof. And I'm going to get into more of the discussion around what do you do when the house is built, the types of furniture and paint, a way of saying what is the R&D tax credit and how does it apply to me? And because I've been presenting on this since 2006, I'm going to make a very bold statement, and it still holds today, because you will not find in Section 41 any industry that is agnostic from taking the credit. It's really about individual facts and circumstances. So here's the statement. If you, as a practitioner, have a client that is a U.S. client, offers products and services on U.S. soil, and they are successful, i.e. they're making money, then there has to be some level of credit for those types of organizations, because they wouldn't continue to be viable, sustainable, mature firm if they weren't always looking for ways to do what they do better, faster, stronger, cheaper, doing more with less, right? So just those competitive pressures, if they're looking at ways to get better, faster, stronger, cheaper, they're going to have some satisfaction of the R&D tax credit. And again, this will make more sense when I get into my portion of the presentation. But again, welcome. Thank you for your valuable time this afternoon.
All right, let's jump right into it here. So as Dawson said, I want to just take a couple of minutes and talk about 41 and 174, just be sure we lay a little bit of groundwork about how things used to work, how they've worked the last 3.5 years, and then talk about 174 and what we've been required to do. And then most exciting, now what can we do to go back and potentially fix, or maybe if you got a large business, go forward and fix. So that's what we're going to do. I believe we've got a polling question here to get going.
Yes, Mike. Poll number 1 has just been launched for our attendees, and it'll be open for the next minute or so. Please get those answers in for us, and I'm here in the Q&A if anybody has any questions. Right back to you.
All right, so let's just talk real quickly. These two sections work together. A lot of folks know this, but I do want to just spend a minute about it so that we understand what some of our options are now for ourselves as taxpayers, or maybe for your clients as you look to help them navigate this. So Section 41 is the one that's been around a long time. It's where we take the credit, and that's what gives everybody the dollar for dollar reduction in the tax liability for whatever credit you come up with. Okay. And again, this credit has evolved for a long period of time. First came into play back in the Reagan administration. And it was designed and to incentivize innovation in the U.S. and have that innovative activity be done here in the U.S. So we're going to talk a little bit about some of the fixes here. All of the fixes relate to domestic R&D activities. So there's domestic and then obviously foreign. The foreign activities are going to remain under the amortization rules. So we'll talk about that in a minute. But R&D credit, nothing changed in the R&D credit world in 2022 when this expensing came into, or lack of expensing came into play in 2022. A lot of taxpayers thought it did, but the R&D credit remained the same. But this was the kicker. 174 obviously threw a big wrench into the way everybody looked at R&D expenses. 174 has also been around for a very, very long time. And what they did was they just changed one paragraph in there that instead of making an election to capitalize and amortize, it was now required. So businesses always had the option to, or their option to capitalize and amortize R&D costs. But then in 2022, it became effective that you were forced to amortize. It was no longer a choice. So what did a lot of taxpayers do? A lot of taxpayers suddenly said, well, hey, I'm not sure I've got R&D expenses. But yet maybe they were taking the R&D credit. So how could you be eligible for the R&D credit, but suddenly you've got to do this big calculation that adds back all these costs. And if you remember, the amortization is over 5 years or 60 months, they call it. But The first year, it was a mid-year convention. So if you had $1 million in R&D expenses in 2022, you had to add back 900,000 to your taxable income. I mean, that was devastating to a lot of businesses. And it forced people into some behaviors. I'm not sure all of those behaviors, where they fall out in the realm of following the code. But we saw several different ways that clients were doing things. And we're going to talk in a few minutes about how to kind of address each taxpayer's issues based on what they did and how they addressed Code Section 174. So let's talk for just a minute here about the legislative side of this. I think there was probably more coverage of the signing of this bill than any other bill I've seen in quite a while.
And Mike, I just wanted to let our attendees know I just launched poll question number 2. So that's out for everybody. No worries. I didn't mean to interrupt you. Back to you.
Yeah. So a little bit more about 174 and where your clients should have been. We had a lot of taxpayers that would call us and say, well, I've never taken the R&D credit. Do I have to do this 174 computation? And the answer is yes. The two were not related. So even if you didn't take or try and leverage the R&D credit for some reason, you still had to come back in and look at 174 and how it applied to your business. What were you doing that met the definition? I believe they called it a specified research expense, an SRE, under Code Section 174. And that could have included a lot of different things. If you look at bullet point 2 here, cost included overhead costs as well. So that was really bad because a lot of times when you're calculating the credit, as many of you know, and Dawson will talk about here again in a minute, is you're looking primarily at the wages of doing the people doing these innovative activities. And then maybe the subcontracted costs of people working on these activities. And then you might have some expendable materials, things like that, leased computer costs. So a very small pool of costs to claim the R&D credit. Well, now we've got this 174 thing, and it says, hey, not only do you have to pick up the labor, you have to pick, or the direct labor, you have to pick up the indirect labor, the benefits, the all the overhead, rent, insurance, you name it. And so it created this accounting issue, not really a tax issue, but how are we going to develop a cost pool in our financial statements that captures all of the R&D activity? So that's what we were faced with, and that's what your clients have probably been agonizing over for the last 3 years. And so now we come through with where we are today, and we've got a nice fix now. And we're talking about here, what happened in the legislation that enabled us to go back perhaps and fix. Remember the cost of this bill. Everybody talked about it for months and months and months about, it's going to increase the deficit. And so us in the R&D world, we were worried that there would be no mechanism to maybe go back and fix this thing in 22, 23, and 24. No way to fix it the way it should have been, because from the get-go, nobody really thought this was the way these costs should be handled. So what ended up happening is we had taxpayers, nobody was happy with this. So what did people do, right? What did they do? They came in and you can see here in the first bullet point, right here, some taxpayers may have said, well, okay, we see there's a timing difference. We're required to do it. We're going to comply with this completely. We're going to continue to pursue our R&D credit like we always have. We're going to go in and we're going to, pay this and make an investment and know that eventually the timing is going to work out that we get this deduction in total, but it's just going to take a while. Now, who are your types of companies that would do that? What we saw was the larger companies, the large businesses that, had external financial reporting, GAAP-based statements. Maybe they were getting into an M&A deal, where in those kinds of deals, you obviously have to, certify that you've accounted for everything properly. So the large businesses tended to do it right, I'll say, to just embrace everything, even though they didn't like it. And in a lot of cases, we saw clients with tens of millions being added back to their taxable income. So it was very painful, very, very painful. The other thing we saw people do was right here. They said, hey, we're going to comply, but you know what? We don't think we have as much R&D as maybe we were claiming back in earlier years prior to 2022. So we'll go ahead and continue to pursue an R&D credit, but you know what? We might have been too aggressive before. So we're gonna continue to do the credit, but we're gonna maybe not have as much credit and not as much 174 cost. So we saw a lot of interpretation there, particularly with small businesses. As we all know, the small businesses really don't have the resources to pay taxes ahead of time and defer deductions. So we saw small businesses really take a hard look at their R&D, and some of them even saying, hey, we don't do R&D at all anymore. Whether that's right or wrong, we don't know, but that's how the small businesses started to look at it. So as we get to the next couple of slides here, I guess Gabe's going to do another polling question.
Yep, I just launched it, Mike. It is launched for our attendees. Again, I'm here in the Q&A if anybody needs any assistance. And right back.
Great. So a quick slide here for your reference. Everybody's known this is a problem since it passed back in December of 2017. The TCJA, it was put in there as a last minute fix to pay for something else, probably the state tax and other things that went into, the lower corporate rate. They dropped the corporate rate big time from 35% max to 21% max, and they're trying to find all these things to pay for it. So they said, hey, we'll just amortize these R&D costs out. So they've been trying to fix it for the last 3 years. Here's all the bills that were introduced, and they couldn't get anywhere with it. And so now we've got this bill that I'm sure everybody's tracked the progress of it last week, I should say. Sorry about that. And now, the House sends this bill over, and at first it didn't retroactively address the problem. Okay, the House bill didn't, but in the Senate bill, which is what became final law, there were some last minute changes last week that you may have heard of, but none of them related to tax issues. Really, they were more in the Medicare, Medicaid, some offsets there. And then I think there was they pulled something out with that AI bill that was also included in this thing. So a lot of distractions around this, but this is what ultimately became final. We've now got everything. The bill, the effective date of the bill is July 4th. However, when you read most of the provisions in it, they become effective around January 19th. The of 2025, the inauguration date. And so that's why they say it's retroactive. But then they went further here with the 174 bill, or portion of the bill, and they said, look, here's what we're going to do. It's going to be too expensive to go back, here is the federal government and say, we screwed up on everything, and everybody gets to go back and redo their taxes and deduct all these costs in a previous year. That was going to create too much of a cost, and they felt like the bill would not pass if that cost was too high. So they compromised, and they said, all right, here's what we're going to do. We're going to first thing we're going to do is we're going to make it go back to the way it was prior to 2022. And that means you get to expense your domestic R&D costs. All right. So anything that's R&D, you get to expense it in the year incurred. Some people may still elect to capitalize it and amortize it. Maybe if they're a startup kind of company, that might be one reason I've seen people do it. But most taxpayers want to expense their costs in R&D in the year that they're incurred. So that full expensing is now allowed, and it is permanent. So remember in the House bill a couple slides earlier, it was not permanent. They were going to let this thing go for another 4 years, and then we were going to have the same problem in 2029 going into 2030 that we did in 2022. So it was still going to be a mess. Imagine if you're a taxpayer and you go, well, do I even want to get back into this R&D thing knowing it's going to sunset in another 4 years? Well, the great news is in this bill, pardon me, it's permanent. So it's not going to expire. Taxpayers are going to be able to expense all of their R&D costs. So that is a great, great provision. Now, they wanted to give relief to small businesses, though, so they set a line out there and they said, look, here's what we can do. If you're a small business, and we're going to define that right here as you're under 31 million in average gross receipts, okay, then that makes you a small business. And so what does that do for you? They're going to allow a small business to go back and change their method of accounting in 22. They're going to allow them to go back and amend the 23 return. And if they have already filed it, amend the 24 return. Okay. So now a small business can go back and they can get refunds because they're going to, remember I used that 900,000 add back example in 22. If they had that, then you're going to look at what's remaining. And so I think if I have my math correct, you would be looking at, 2022, you would have deducted 10%. And then in 23 and 24, you would have deducted another 20% in each of those years. So that would mean 50% had been amortized. And now we would go back as a small business and we would be able to deduct that remaining 450,000 in the 2022 year. Now, the way I should remind everybody, we don't have any regulations out on this yet. So we're not exactly sure the methodology of amending these returns. I'm sure there's a lot of folks who want to go ahead and amend right now. But we do need to see the regulations. Those should be out shortly, and follow the procedures that are out there that the IRS lays out for amending these returns. But what you could see, I think, I just described one way of looking at it. I think what they'll probably come out with in the regulations is, hey, we added back 900,000 in 2022. We're going to go back and amend 2022, and we're going to deduct that 900,000. Okay. And that's going to create a refund, and that will come back to us. Then we're going to move into the 2023 year, and we're going to look at what happened in just that 2023 year. Well, what happened? You got to deduct you had to add back another 900,000. Let's assume we had the same million in R&D costs for 23 as we did in 22. So we've got a 900,000 add back, but we also got to take 20% of the 900 in the 2020 that was initiated in the 2022 year. So in 2023, we now have a net of the two. We've got a 900,000 add back, less amortization from the previous year of 180. Okay, so we're looking at about a $720,000 adjustment in that example. For the 2023 year, you deduct that 720, get a refund, and now we move into the 2024 year. So I won't go through that year because the math gets pretty boring, but that's what's going to happen if you're a small business. Now, what is a small business? Well, it says right up there, under 31 million. So how do we go ahead? How do we determine if we're a small business? Well, we're in the 2025 year. And to determine this year for 2025, whether we are a small business, we go to the 3 preceding years of gross receipts. It's net revenue, box 1C of your business return usually. And we're going to look at the 2024 number. We're going to look at the 23 and we're going to look at the 22. So those are the 3 test years. We average those up, and if you're 30,999,999 or less, you meet this definition, and you can go back and amend, and you can get some pretty nice refunds. So that's a great advantage for small business taxpayers. Large businesses, it's not bad. You just don't get the ability to go back and amend. But for a large business, as we can see here in the second bullet, you have to look at it going forward. So you've got a choice. They're going to let you look at just deducting the unamortized portion of all 3 of those previous years, 22, 23, 24. Add up what's unamortized, and you can deduct it all in 2025. Or you can ratably do it over 2 years, which I'm assuming means just divide it by 2. We haven't seen anything definitive on that yet, but when they use words like ratably, that usually just means we'll split it and do it over 2 years in 25 and 26. So we're going to talk about some scenarios in a couple of minutes that you might want to think about for clients, or if you're a taxpayer listening in this afternoon, maybe some things you should consider. It looks like this is all going to be done here, bullet point number 3, with an automatic change in method of accounting. So there's probably there may be a brief 3115 required to do all of this. Again, we should have some guidance on how to do that in the next couple of weeks. All right.
And Mike, I'm going to go ahead and get that next poll question launched for us. This is our says 5 on the slide there, but we're going to get to all 6 today. So again, I am available in the Q&A if you need anything.
All right, great. Okay, so now what can we do? All right. Now, this slide is very busy. We understand that. And we did this in a separate handout so that you can see it and take it in a little bit better. So I don't want you to squint in and look at this too much right here today. Let me just walk through with you a couple of things that I think as practitioners we should think about for our clients. And so again, these are experiences that we saw. We do R&D credits for several hundred companies around the country, and like I said at the beginning here, a lot of taxpayers took different positions and tried to justify what they did. So in the upper left-hand corner here, we're going to talk about the six most common things that we saw. All right. And there's three that affect small businesses and three that we're going to analyze for the large businesses. All right. So the first one, if we look at this, is we had a taxpayer that they said, hey, we're going to fully comply with 174. We're not going to, try and say we don't have R&D or anything like that. We're just going to comply with it, and we're going to continue to take our R&D credit, just like we always have. Saw a lot of that. That was most people. Well, if you did that, then your opportunity as a small business is what I just described. It's a good opportunity to go back and amend your 3 previous years' returns and get some refunds, have 3 nice refund checks come through. Now, for most of you, if you're practitioners, we're kind of in the extension season for 2024. So what do you do if you're a small business and, we're sitting here July 8th and we've got a return on extension till September, October, whatever it is. So we haven't filed yet. Okay. And we're a small business. So are we required to amortize our 174 costs for 2024, and then go back and amend after we make that filing? We don't have a definitive answer on that because we don't have the regulations. But here is something to think about as a practitioner. If you went in and on the extended return, you amortize those costs, and so you had a big add back again for 2024. Well, you would have the ability to go back immediately after filing that and amend that return to claim a refund for those same amortized costs. Okay. And since you're doing it year by year, you would really only be, and you're most likely going to go back and amend 22 and 23. It would be a wash. You would add back let me keep using my $1 million of R&D cost example. You'd add back your 900,000, but then you'd file for 2024 an amended return immediately. So that doesn't make a lot of sense to us as our tax team is looking at this. I think if you're on extension, I believe the way it's going to work is you just don't need, and you're a small business now, because this is going to be a big difference with the large businesses later. But if you're a small business, there's not a need to amortize those costs in your filing, your original 2024 filing on extension, because you're going to have the ability to go back and amend immediately. Okay. I mean, you could amend it the next day. So that's something we hope we get some really clear guidance on here in the next couple of weeks. But I don't think, obviously we just had Congress pass this. I don't think the practical side of it has been fully thought through yet. But that's something to consider if you've got any small businesses on extension that we're kind of waiting to see what would happen with this bill. The next thing that people could have done is right here. And again, I realize, hope you're looking at your separate sheet here. But we had a few folks said, you know what? We're going to delay how we're looking at 174. And I can't believe it, but we had people go, we're not going to do a 174 deduction, but we're going to continue to take the credit. I guess the small number of people who did that, I guess they kind of got away with it. I don't think the IRS is going to go back and audit any of these. We see R&D credit audits all the time, but in no case that we've seen in the last 3 years has the IRS even brought up 174. They've just not even ever brought it up. It's never been on their radar in our experience. So we did have a few people kind of rolled the dice. Not very smart in my opinion, but they did. So what do we do here? In this situation, I think those folks continue on as if nothing happened. There's nothing to go back and amend for. And if they've been claiming the R&D credit all along, they would just continue to do so and expense everything. The third situation is we may have said, hey, full stop on this. We're a small business. We think we can do some things to bust the 4-part test, meaning we don't think we have any R&D. So we're not going to do 174, and we're not claiming the R&D credit anymore. It's just the cost of making that decision. Now, there's all sorts of issues there with your clients. Can you really do that? Are you really not doing R&D? Was that a valid position to take? Maybe based on facts and circumstances of each taxpayer. But we look here, and in this case, there may be a real opportunity now. Obviously, if you didn't do 174, there's nothing to go back and amend for there. But these clients may be willing to look at going back and amending to claim the R&D credit itself, since they hadn't claimed it in those earlier years. And so remember, 2022 year is probably getting close to statute, about 8 months out, I think, from July 15th of this year. The first extensions would start expiring in March of next year, 2026. So those are kind of 3 situations we've seen with our client base over the years in dealing with this. The big issue, I think, is as we get into these large businesses. If you've got any large businesses out there, now we might have the same 3 scenarios. We said, I don't know of any large businesses that didn't just go ahead and say, we're doing this. We don't like doing it. We had a lot of those discussions, a lot of CFOs under pressure from their boards and their CEO and president didn't understand why they had to do this, but they did it. And so those companies are going to look at their tax situations and what their income's looking like for 25 and 26 and try and make a decision as to what they should do. And should they try and take all of those unamortized costs in the 25 year, which, hey, that might create a big loss. Maybe we spread them into 25 and 26 and utilize it that way. I would suggest, since in this scenario they're continuing to do the R&D credit, I would suggest you plan to use those expenses in a way that you can still claim the credit, because remember, the credit's a permanent thing, a permanent difference. So in your long range tax planning, you always want to maximize those permanent differences. So there's a lot of ways large businesses have to look at this a little bit differently. If you have scenario 2 where a large business didn't embrace 174 and still tried to claim the credit, now I think what you should do for 2024, especially if you haven't filed and you're a large business. This is a difference in our opinion for the small businesses now. You better add those expenses back in 2024, because for 2024, it is still the law that you have to amortize those costs. And unlike a small business, you can't file that and then file an amended return and get it back the next day, theoretically here. So if you're a large business, you better continue to amortize your 2024 costs, even if you haven't filed your returns yet. and then do the right thing and take the rest of those 2024 costs in your 25 or your 25 and 26 tax returns. So again, big difference there. Focus on your extension clients and just be sure you recognize whether they're large or small and what their options are. Okay. So not great for large businesses, but again, not terrible because you can get the fix in the next 2 years. All right. So here on this slide for later, we put some of these recommendations down. Each situation is going to be a little bit different. I mean, I'll give you a couple of situations that might come up. Let's say I'm a large taxpayer. I add my expenses back, and I've added so much back. Still taking my R&D credit like I always have. Well, what if taking all of those costs in 2025 is going to create a net loss? What if I'm a C Corp? I may generate a loss that perhaps I could carry back. These are things that we haven't seen addressed in the regulations yet. So that is an option as well. It may be that's even better than having to go back and amend if you could create a loss and carry it back. I know we had several clients that had, and I'm sure a lot of you on this presentation today heard it from your clients. We had one client that had a 95% effective tax rate for 2022. It was bad. So a lot of costs in there, may create some losses and let you carry back. A lot of scenarios to think of. And it's probably going to be very facts and circumstances oriented with each one of your clients. Okay. So again, we've summarized what's in this chart here and what to do if you're a small business or not a small business. Let's look here. Let's do our next polling question.
All right, let me go ahead and get that launched for us. This is our 5th question, and we will have one more after this that we're going to work in, but I'm available in the Q&A if anybody needs any assistance, and right back to you, Mike.
Okay, great. So we're about to go into, I want Dawson to kind of remind us what R&D is, because a lot of taxpayers have come through this 174 era the last few years, and they really challenge what the definition of R&D is. We even had just a quick story here, a client, lot of design work, good fixed price contracts that gave them both rights and financial risk in the activities. IRS comes in and challenges their credit. Okay. And so the IRS comes in, and as most of you know, the first pass at exam, it's usually a disallowance these days, and you have to go to appeals to get a favorable settlement. Well, this client didn't want to go to appeals. They looked at it and they said, you know what? We're just going to give up on the R&D credit. We're going to let the IRS tell us we don't deserve it, because that means we don't have R&D and we don't have to do all this 174 computational stuff. And that's going to save us a lot more money in the long run. And so that was a business decision that they made. Now, what I think they didn't really consider is what R&D really is, and does a taxpayer, how should a taxpayer look at R&D, especially in light that we're back now to being able to expense those costs and really reap the benefits of a credit if we're qualified. So with that, Dawson, do you want to take over the next slide?
Please, gladly. And so I can start navigating on here, but thank you, Mike. So again, digressing back to the way I started the presentation, because I've presented on this so often in the last 18 or 19 years. As practitioners, I want you guys to understand, and again, it's kind of a challenge. And if you're ever, I guess I'll start this way. If you're ever bored, bouts of insomnia, go check out Section 41. It's a good read. It'll help you out. But what you'll find, or what you will not find, or what I would challenge you to find, is that there any industry that is barred from taking advantage of this incentive? And the answer is no. I mean, it's ubiquitous. It really is open to all industry, and it really does come down to facts and circumstances. Obviously, the facts and circumstances are a little bit lower hanging fruit for light manufacturing, engineering, design, software, those types of things. But everybody in the 21st century is now touching technology. So computers, software, connectivity, those types of things. And some of those activities will flow into qualifying activity. So even though you might think that, hey, this nomenclature of R&D, it simply means white lab coats, petri dishes, and the scientific method, I will challenge you that it's more when we start highlighting Congress's definition of how they define R&D. Again, just rehashing some of the things that Mike said, established back in 1981. It was at that time when Reagan was brought in, and we were the first country in the world to have this type of incentive. And it really was pushed down to those research facilities, white lab coats, petri dishes, and for groundbreaking innovation. Well, in 2003, when they modified this incentive, it removed what was called at that time the discovery test, that something had to be groundbreaking, new to the world for it to qualify. That test was removed. And so it really comes down to is what's new to the taxpayer? Is this service offering new? Is there aspects in that service delivery that are new? Or whether it was a true tangible product, it's new to the taxpayer, not new to the world. And this word innovation gets thrown around a lot too, but innovation doesn't happen without humanity. Innovation is just a word. And if you understand the definition of the word innovative, it simply means looking at what's not working and creating change. New means new methods, and those types of things. So a lot of firms that are hitting innovation, even though that innovation word seems like a high barrier to entry. So again, please understand, it really comes down to facts and circumstances, open communication, find out what they're doing and how that aligns with the code. The intent is really, again, to reduce the high cost of U.S. innovation, U.S. employment. I think that's enough on that slide. Eligibility, it's open to all U.S. companies with the caveat, they've got to be federal taxpayers. So if it's a fully owned ESOP, unless you're a C Corp ESOP, that would throw you out, but most everything else, sole practitioners, partnerships, etc. I think that's a good slide.
Hey, Dawson, I'm going to jump in and just get our last poll launched for our attendees so we can get that done. Poll 6 open for our attendees. I'm here in the Q&A if anybody needs anything, and right back to you.
Fantastic. So some of the reasons over the years that we've seen of companies evaluating the credit saying, hey, it's not for us. Obviously, I highlighted one of them. We're not doing R&D. We're not like white lab coats, petri dishes, the scientific method. Again, hopefully I assuage some of that, to open it up and look at all your industry segments that you touch. But here are some of the other, low-hanging fruit. We don't document our work. That is something we hear quite often. Now, I will say that because for those firms that weren't aware of the credit, they weren't aware of the necessity for documentation. So when they start looking at their first onset of taking advantage of the credit, they're given a pass. It's called the Cohan Doctrine, and I'm not going to get into it too much detail, but you are offered a pass, the ability to use high level, some level of estimation for the type of service and or product that you deliver to the U.S. workforce. But once you've taken advantage of the credit, you do have to have some level of documentation. But that's where a firm like ours can help you navigate. How do we document this without being a burden? Because we're not in the business day in and day out of taking advantage of an R&D tax credit. We don't want it to be cost prohibitive. So we will help you, guide you through what that documentation looks like. Again, our activities are not innovative or groundbreaking. Again, are they new to you, though? New to you, to the taxpayer, for the purposes of making what it is that you do better, faster, stronger, cheaper, doing more with less, okay? We're an S corporation. Again, it's open to all entity structures other than non-tax paying entities. And I do want to highlight this one. This one will trigger an audit. Mike highlighted earlier that we see a decent number of audits on the R&D front, but let's quantify that. Currently speaking, there are probably on average up to about 30,000 US businesses that take advantage of this incentive. Okay. The numbers are still less than, it's when the credit came out finalized in 2003, there was a period of time between 2007 through 2012 where almost every return was audited. It was called a tier 1 audit issue. That was removed 3 years down the road by Commissioner Schulman at the time, because what they thought they would find is that firms were making high-level estimates, making invalid assumptions, et cetera, but they did not find. What they found is that 99% of taxpayers were being voluntary compliant and following the regulations. So before that tier 1 audit issue, national audits were less than 2%. During the time frame of all firms taking advantage of the credit, during that tier 1 audit issue, 2007 through 2012, it was upwards of 5%. Currently, we're less than 3%. Mike, your team knows a little bit more, but it's in between that 3 or 4% of, globally speaking, of how many firms taking advantage of the R&D credit. Again, it comes down to facts and circumstances and making sure that you have a good foundation of why it is that you qualify, or how your activities are following the 4-part test. Okay. We're not profitable. Again, it really comes down to if you're forecasting to be profitable, because it's a 3-year look back, it might make sense at least to be educated on what the R&D is. When should we start using it? When does it make sense to reach back and roll back some of these potential incentives from prior years? So it really, again, comes down to facts and circumstances. Reasons to take the credit. Again, it's pretty ubiquitous. Everyone's going to have some kind of unique fingerprint on what the reasons are. Maybe it's profitability, strategic planning, mergers and acquisitions. Again, I'll let you make that determination. But it is a dollar for dollar, the most powerful tax incentives on the books, and why it makes sense to at least explore it, even if you explored it 5, 6, 7 years ago. It was and continues to be the most powerful political football on the incentives around, because it's a tax credit, orders of magnitude greater than the deduction. So at least makes sense to look at it now with the focus of this new legislative passed law, and just keep it on your radar for your clients. I guess what I want to highlight in this slide, it is primarily a wage-driven credit. When we look at a study, there are 3 expense buckets that drive these incentives. 90% of taxpayers, it's going to be their W-2 wage. Okay. And then for manufacturing firms that are having annual purchases, there's an opportunity that some of those purchases, annual purchase expenses, will fall into a QRE, a qualified research expense. Typically, again, the lion's share is going to come on the wage expense side. But for light manufacturing, they might be purchasing raw steel as an example that's pushed into prototypes, that can't be resold, or those expenses recouped that would fall into a potential qualifying research expense. And then just by extension, third-party contracting. So to the extent that you hire an outside entity or an outside individual that happens to be working on activities that pass the 4-part test, you can augment your research credit by pulling in those expenses. But again, the primary driver is W-2 expense. Okay. So again, I'll go back to Section 41 is where this credit lives and breathes. And it basically says, in layman's term, R&D, how Congress defines R&D, is the development of a new or improved business component. Okay, just a fancy way of saying new or improved product, new or improved process, software, technique, formula, or an invention, which would be a patentable type activity. And it goes on to further define that activity will qualify, and then the wages tied to that activity if it passes what's called the 4-part test. Okay, so this is kind of an unpack on what how Congress defines R&D on steroids. Okay, so the first test is called the new or improved design, or what we would call the permitted purpose. And it basically says this: the taxpayer is attempting to do something new or improved to that product's function, its performance, its reliability, or its quality. Okay, and attempting is a key word. The credit is agnostic to the outcome. It's about the attempt, whether you succeeded or whether there was a false start. It's about the attempt. Okay, and again, it's either a new product or an improvement to a current product, or it's a new process or an improvement to a current process through all those business component types on the left-hand side. Okay, just remember, attempt is the key word. You're not doing these things. Your clients are not getting into these products and or services for the fun of it, right? They're attempting to do something. We go on to the second test. What we know is the technical uncertainty or technical risk question. And it basically says the taxpayer is endeavoring. Whenever I say taxpayer, think about your clients and their people that make these innovations or make these services and products they fulfill on those things. That's what I mean when I say taxpayer. But basically what this test says is that the taxpayer is endeavoring to discover information they did not know before they started the new design or improvement to the design of a product and a process or software. Okay. And where the risk is that you could have 5 people with a paying client saying, okay, Dawson and Mike, we'd like your firm to fulfill on X. Okay. And those 5 people are going to be evaluating the facts and circumstances to be able to build this mousetrap. And what you're trying to figure out is, based on what I understand, what's the appropriate and final design to go about this mousetrap? Okay. So you could have these 4 or 5, half dozen people, after they learn the facts and circumstances, they go back to your office and figure, based on their history, their knowledge, their expertise of what they know, well, I believe this is the best way to build this mousetrap. But you could collectively have 4 or 5, a half dozen different approaches. And that's where the risk resides. You have this wage being expensed, trying to figure out what's the best and appropriate design. You can't just have anybody in those meetings. You couldn't put someone in a bookkeeping position that has to answer an engineering question, right? You've got to have those right sorts of expertise within those fact-finding missions to get to the final answer of what's final, what's appropriate, the best way to do it. That's where your technical risk is. The third test is technological in nature, and this really kind of encapsulates the congressional intent, why this legislation exists in the first place. It's called the technological in nature test, and it says the taxpayer is relying on the principles of a physical science in getting that product and or services out the door. Those are the types of jobs and know-how that the U.S. economy is trying to maintain, sustain, and grow here in the U.S., and why they're incentivizing it. So it's principles of science, engineering, physics, chemistry, biology, computer science, i.e. software, as opposed to those more anthropological or feeling type, aesthetic type characteristics like taste and feel and color. Again, it comes down to technological in nature. And then the final test to round this out is a process of experimentation. It says the taxpayer has evaluated at least one or more alternatives in an effort to address the design uncertainty you had in the second test. Okay. And all the years that Mike and I have been at this, there are really only 3 major, fact patterns that highlight a process of experimentation. The first one is, we all know it. It's called the scientific method, right? You have this control group, you have this hypothesis, you have this control group, you introduce a variable, you measure the outcome, and you document it. Okay. Probably more formal than most everybody on this broadcast this morning, but you're certainly touching the last 2. Second one is called the evolution of the design, starting from concept through final delivery. So there's some kind of phase code, pre-design, design development, schematic design. That's where most of the R&D is happening. There'll be some in the construction administration. But again, it comes down to facts and circumstances, but your evolution is from concept through final delivery. And the third one, we all know it, and it is a tried and true and recognized process of experimentation. It's simply trial and error. Look at what needs to be accomplished, rolling up your sleeves and getting it out the door. Okay, so that's R&D on steroids. And the way to kind of boil it down is, if I were in your offices today, I would give this very quick rendition education of how Congress defines R&D, but I would simply ask you 2 questions. Number 1, did you do anything today that was neck up work, i.e. using your head, problem solving, designing, drafting, conceiving, resolving uncertainties? And number 2, did you ever do those things in an effort to make something better, back to the new or improved? And if you answered yes, there's a good chance that your clients are going to be satisfying aspects of the 4-part test.
And Dawson and Mike, we are coming up on the hour here, and I realize we have a lot of great material to cover. But if I could ask y'all to wrap things up for our attendees, and then I can wrap things up, they will get these materials in their CPA Academy accounts as well.
Yeah, fantastic. And again, there's some ancillary things that are regulatory here. Again, we'd be open to discussions to help you understand those regulatory changes. Just know that there is some level of documentation once you get into the guts of the R&D, but it's not as much as you think. Contractor fees. This is where you're coming into if it's a service. Some people say, well, Dawson, we don't make a product in our service. It's our expertise. How do we get advantage? How do we take advantage of the credit? Well, it comes down to how you contract with those clients. Typically speaking, generally speaking, if you're in fixed bid contracts or time and materials contracts not to exceed certain caps, you have the right sort of economic risk, as opposed to those that, hey, Dawson, regardless of the outcome, we're paid for our services. That would be called funded research. Again, aspects that we can get into. High level mental. Go ahead, Mike.
Well, I'll just add, since we're here at the time, I'll just add that we'll probably see, I said regulations earlier, we'll probably see a notice like we did when 174 first changed back in 2022. So let's watch for a notice that tells us how to handle some of these amending situations. So that will be coming pretty soon, I think. And again, I know we're out of time. Please share with us any questions. We're happy to get into it and answer any questions that anybody has. Thanks again.
All right. Thank you so much, Mike and Dawson. We really appreciate having you with us here today. To wrap things up for everybody and to wrap things up for our attendees, the handouts, archive of the webinar, and CPE credit will be available in your CPA Academy accounts within 24 hours. CE credit for attendees with a P10 on file will be uploaded to the IRS at a later date. And if you look in your email inbox, you'll find an evaluation link for this webinar, so please let us know how we did. All questions that were asked today will be forwarded in a full report to our presenters as well. Thanks again to Mike and Dawson for your excellent content and to our members for your participation. Please check the schedule on our website for additional information, and we hope to see you on a future webinar. Have a great day, everyone.
Bye, everybody.